What if the smartest money you could make happens when others panic, and the dumbest when everyone cheers? In this video, I'll show you how the enterprising investor looks for overlooked opportunities, and why the market's mood swings are actually your greatest tool, if you know how to use them. Stay with me and I'll give you the exact negative and positive filters Benjamin Graham used to find bargains, plus the mindset that keeps investors calm when Mr. Market is manic. Chapters 7 and 8 move from what investors should avoid to what the enterprising investor can do, and then to how every investor should behave around market swings. Chapter 7 gives the positive playbook for enterprising investors, the strategies and special situations that can outperform if executed correctly. Chapter 8 introduces Graham's famous Mr. Market metaphor and teaches how to use market fluctuations to your advantage, instead of being bullied by them. These ideas are essential whether you want to hunt bargains or simply stay sane while investing. The enterprising investor is willing to spend time and effort to earn more than the defensive investor. That means researching, screening, and sometimes taking positions that require homework. But Graham doesn't encourage blind activity. He prescribes specific, disciplined methods that tend to produce reasonable odds of success. This chapter is the positive side playbook, what to do if you're going to be active. Graham highlights a few categories where enterprising effort can pay off: arbitrages and special situations, reorganizations, liquidations, merger arbitrage where careful legal accounting work reveals a price gap, purchasing low-priced or neglected securities, small, undervalued issues that the market has overlooked, related hedges and convertible situations, structured plays using convertibles or preferreds, combined with stock positions to limit downside while keeping upside, buying bargains among ordinary companies, identify good businesses temporarily out of favor, so you buy with a margin of safety. Special situations can offer outsized returns, but they require detailed legal and financial knowledge. Graham emphasizes careful calculation of probable outcomes and conservative assumptions. Successful special situation investors treat their work like a technical job, reading restructuring plans, valuing assets conservatively, and building a high margin of safety into each trade. One of Graham's classic approaches: find stocks trading at significant discounts to their net current asset value or to conservative estimates of business worth. These net or deeply undervalued names aren't glamorous. They often look boring or troubled, but when priced cheaply enough, they offer a built-in buffer. Graham stresses, be patient, diversified, and buy only when the numbers give you a real margin. Convertibles and carefully structured hedges can give you upside participation while limiting downside, when used sensibly. Graham warns against complexity for complexity's sake. Only use these instruments when you fully understand conversion terms, interest coverage, and liquidity. He also suggests pairing senior and junior securities to protect downside while capturing potential gains. Even when you're searching for special opportunities, Graham insists on diversification and sensible position sizing. Enterprising doesn't mean concentrated bets on a hunch. It means disciplined work across many small, well-researched positions. Treat each idea like a project with a target return and a stop-loss threshold. If you want to translate Graham's methods into today's screener filters, consider deep discounts to book or working capital, consistent asset backing relative to price, special restructuring announcements, convertibles trading below conversion parity. Always build in a margin, e.g., only consider names 30–50% below conservative value estimates. Graham's Chapter 8 introduces one of investing's most famous metaphors, Mr. Market, an imaginary business partner who shows up every day offering to buy your shares or sell you his at a different price. Sometimes he's euphoric and offers generous prices. Other times he's depressed and offers rock-bottom deals. The intelligent investor treats Mr. Market as a servant, not a guide. Graham's core lesson: market prices fluctuate for emotional reasons and for rational ones, but they're not the same as a stock's underlying value. That means price swings are opportunities. When Mr. Market is irrationally pessimistic, you can buy value. When he's irrationally optimistic, you can sell or trim positions. Your job is to estimate value and let the market's moods provide opportunities to trade around that estimate. Volatility, short-term price movement, is not, in Graham's view, the same as permanent loss. If you own a sound business and you don't need the money immediately, short-term dips are paper losses, not disasters. The real risk is paying too much for a poor business or being forced to sell at the wrong time. That distinction changes how you react to market chaos. Graham gives practical behavior rules for market fluctuations. Have a valuation anchor. Know what a company is worth to you, not what the market says today. Use volatility to your advantage. Buy on dips when a margin of safety appears. Sell when prices far exceed intrinsic estimates. Don't try to time the market. Instead, follow formulaic approaches, dollar cost averaging, periodic rebalancing, that force buying low and selling high over time. Be emotionally prepared. Accept that the market will test your discipline. Prepare rules in advance so you don't give in to panic. Graham demolishes the fantasy of consistent market forecasting. Prices move for reasons you can't reliably predict. Instead of forecasting, he argues for a measured approach. Analyze businesses, define a margin of safety, and act when prices deviate meaningfully from your estimate of value. Over time, this policy trumps attempts to predict the market's next mood swing. Here's a simple plan to manage market fluctuations. The Graham way. Keep a target allocation, e.g. your stocks, bonds, guardrails, and rebalance when allocation drifts. Maintain a reactive playbook. If a stock you own drops 30% but fundamentals hold, consider buying more. If the price runs far above your conservative valuation, trim. For defensive investors, adopt passive rules, index ownership, dollar cost averaging. For enterprising investors, set stricter entry price thresholds and position sizes for special plays. 4 practical principles from chapters 7 to 8 you can use right away. Do the homework for special opportunities. If you're enterprising, focus on arbitrages, net bargains, and structured plays, but only with conservative assumptions and proper diversification. Use convertibles, hedges only if you understand them. Complexity without comprehension is a trap. Treat Mr. Market as your tool. Price fluctuations are opportunities, not commands. Buy when pessimism makes value appear. Sell when euphoria inflates price. Behavior beats prediction. You'll do far better by having rules and sticking to them than by trying to forecast every market twist. Which of Graham's approaches speaks to you more? Hunting special situations or following Mr. Market's bargains? Are you defensive, enterprising, or a bit of both? Tell me in the comments. Best answers may be featured in the next video. If this was useful, like and subscribe for more breakdowns of classic investing wisdom. Next time we'll apply these concepts to construct a sample enterprising trade and walk through the conservative math that makes it attractive, so you can see Graham's methods in action. Want a downloadable checklist of enterprising screens and Mr. Market rules? Say checklist in the comments and I'll add it to the description.